Hi, everyone. It's good to be talking to you again. As we see the global markets in terms of how they've panned out, there's been a significant drop in bond yields. Now, everybody's talking about the Fed pivot, which means they expect that at some time in the next one or two meetings, the Fed will slow down the pace of its rate hikes, and also eventually indicate that they will pause at some level. They're currently at about 3.75 4% on the Fed funds, and as they get closer towards 5, they will be pausing and taking a break there. And that has led to a significant drop in long-term bond yields. Short-term bond yields have moved up, but the 10-year and 30-year US treasuries have actually been down by almost 30-40 basis points in the last month. We think that the markets may be reading the Fed either too dovishly or kind of or wrong, because we believe that the Fed, although the pace of the rate hike will slow down for sure, but the fact that the Fed will actually remain and keep rates higher for longer is there to stay, unless they are convinced that the long-term inflation is well below 3%. I don't think they will take their leg off the pedal. So they might take rates to a level and stay there for some time and allow the entire rate hikes to feed through. But the rates are unlikely to come down unless the economy sees a very brutal recession. And from that perspective, I think the data that is coming out of the US markets is actually fairly strong. Like if you look at every aspect of services, retail, uh, manufacturing activity, and job and wage growth is actually very, very strong. So they have a higher inflation fight to manage as compared to worrying about a oncoming recession. So which would mean that interest rates will remain high, which would also mean that cost of capital will remain a very, very big aspect. So 10 years back or during COVID, the cost of capital or a discounting factor was so low that people could price off assets like cryptocurrency or venture capital or tech at a very high valuation. But now that the cost of cash is now 3.5 4% across the world, it has a significant barrier to risk assets. And we are seeing some of that in the crypto markets. Cryptocurrencies have corrected quite significantly. Bond markets have sold off quite a bit. This has been a fairly brutal year from a bond market return perspective globally. We've also seen commodity markets correct. So especially oil, which was the biggest worrying factor for India. Uh, it has corrected from about $100 to now below 80. We don't see the oil prices going below 70 because at that level, I think US and other economies who gave away their strategic reserve will start rebuilding strategic reserves. So we don't see too much downside. But if oil prices remain in this 75, 85, 90 level, I think it's a big comforting factor for India. As you know, the Indian rupee will remain supported if oil behaves like that. We've seen other commodity prices correct as well. So quite a bit of the container shipping, some of the metals have actually corrected quite dramatically in the last 3 4 months. So that is a good factor for an importing country like India. But if you look at the RBI monetary policy that was given out today, there is a clear worry about the rupee. And today's monetary policy from RBI was a very clear statement in their intent to tackle inflation, and by that keep interest rates at a reasonably high level, which will also support INR. I think they continue to worry about the extent of the Fed cycle, how long the Fed will remain at a high level, and what that means to dollar and what that means to capital flows. And until that time, I think monetary policy in India will remain kind of, as they say, hawkish, or they will have to keep interest rates high. Uh, uh, the bond markets in India, if you see bond yields, are at long-term historical averages. The 10-year, 20-year average of the 10-year bond yield is about 730, 740, and we are at that level. So it's but much more comfortable from a bond market perspective. But if there is a pressure on the rupee and we continue to see capital outflows from the equity markets, uh, the RBI either will have to keep rates high, or the India generally used to tap the NRIs, the non-resident Indians, whenever they had a balance of payment deficit. We think that will also be difficult, because if global interest rates itself is about 3, 4, 5%, if that money has to move to India, the level at which India will have to offer that uh, uh, rate to attract that NRI deposit money will be fairly high. Which again goes back to the fact that although Indian inflation is nowhere high or away from its long-term average as compared to the Western world, and RBI is fairly confident that that the inflation will settle below 6% for now. They will still keep interest rates high, which would mean opportunities in the liquid fund, small, shorter tenor segments, or even fixed deposits where rates keep going up. But also in the longer tenor, we've been advising clients to start investing in long-term bond funds, or dynamic bond funds, as we call it. uh, the Indian equity markets also continue to be in a tear. I mean, every day we are kind of hearing new record highs being set. And this is, although there have been some foreign inflows recently, but most of this continues to be a very domestic retail plus HNI driving the markets. Uh, Foreigners on an average have been net sellers quite dramatically, and from there it's a relative valuation, right? So given India's outperformance, and given the underperformance in some other emerging markets, I think money is being taken away from India and being allocated to other underperforming or better valuation markets. In India also, pockets of the markets are getting expensive, but we remain fairly confident of the economic rebound that India is seeing across parameters. Corporate balance sheets, banks, credit growth has picked up, and banks are in a much better position to lend. Residential real estate market across the country is picking up. Lands, we are seeing land sales, and land sales activity is always a good precursor to eventual residential activity. Across different segments of the economy, we see a broadening of the economic recovery. Consumer sentiment, as seen by the CMI indices, even they've gotten better, which means that people are finding jobs and are finding economic opportunities. And when that happens, we've seen that the opportunity set for especially Quantum's value investing product gets better. It gets more broad based, and so although markets seem at record peaks, but we still see reasonably good upsides in our equity portfolio. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.